Welcome to FinCorp 360, your smart guide to finance, accounting, and business knowledge. Imagine discovering that your business bank account doesn't have enough money to pay your staff. You suddenly need cash, and you need it fast. One option is selling shares your business owns on the stock market. Another option could be reducing inventory by running a quick sale. You could call customers who owe you money and ask them to pay now. Or you could sell one of the motor vehicles owned by your business. The first options are easier, but selling a motor vehicle feels different. This is where the concept of current and non-current assets comes in. Current assets include shares, inventory, and accounts receivable. These assets can easily be converted into cash. They are usually held for less than 12 months. Current assets help businesses meet short-term obligations.
Non-current assets are assets held for more than 12 months.
These assets provide long-term economic value.
Examples include plant and equipment, computers, and vehicles. Intangible assets like trademarks, patents, and goodwill are also non-current assets. Current assets support short-term needs. Non-current assets support long-term business growth. On a balance sheet, assets are divided into current and non-current categories.
They are listed in order of liquidity.
Cash is the most liquid asset, which is why it always appears first on the balance sheet. Other current assets follow in order of liquidity. Goodwill usually appears last because it converts into cash only when a business is sold. To summarize, current assets help with short-term needs. Non-current assets support long-term business operations. If you're a student, beginner, or professional looking to master finance and accounting, subscribe to FinCorp 360. Thank you for watching. See you in the next lesson.